Hey traders, welcome to this video. This is just another really great trading lesson that lots of people really should know. And that's more or less to survive the inevitability of the black swan, or when the market swings massively against you. Now, I personally teach this a lot, and I did do a big video on this, and a lot of people saw it. But here's just another one to clarify. So you can see on the dollar yen chart, of course, we started all the way down here at 102 area. Okay, and of course we rallied and rallied and rallied. I'm going to put this arrow slightly round the other way so it's a bit clearer. So we landed down here, December, just at the end of 2020. So starting off 2021. And what happened on this fall is lots of traders probably got closed out if they didn't know what they were doing, but more so, they got closed out on the way up because it rallied and rallied and rallied for such a long time. Now, the purpose of this video, as you've probably seen in the title, is all about sustainability. So it's, can you sustain something like this? Because if you know the answer is no for you, you're going to find out the hard way when you start getting margin calls and things get too rough. So at all these points here, you have to think to yourself, could I survive all this way up? Now, the way I do it is very unique, and it involves hedging on the other side of the market, fast hedging and accumulating gains to offset any loss. But you really have to ask yourself, no matter what your method is, can you survive this? Okay, now this is an enormous move for fundamental reasons, mainly interest rates. And it's an inevitability. It doesn't matter what you're trading. You're always going to see something like this. So before you even start, you're going to need to know, do I know how to control my risk? Because I'm going to get a black swan. I'm going to get a market swing. Now, if the answer is no, as I say, don't start trading. You're going to need that to get going. And the way you can do that is in several ways. Mostly, you want to use higher time frames when you start rallying away. Because the higher the move away, for example, like now, the more likely it is that you're not going to touch on price action levels that were nearby. So, for example, once you got to this point here, okay, you would find you were this far up the move. And that is the nearest price action level. Now, once you go higher up, you're going to have to reflect further back. And you can even use yearly charts for this, as there are key levels on yearly charts. So the further away the price goes, the higher you want to use your time frames. And that's going to allow you to be more sustainable when you're trading. Okay, now you can see the market does actually stop, rather funnily enough, at this price action level here. Okay, so this minor candle wick, you can see where the arrow is. And that's not a coincidence. That's simply how the market works. We stop at candle wick levels. So if that's your target from down here, can you survive it? That is the question. So as markets rise rapidly and come away, eventually you have a fallback, and often you will stop at what we call early support. And you can see that's exactly what happened here. And again, no surprise, the market bounces up. Okay, and you can see your stochastic oscillators down at this point. And the market bounces up, and you haven't got much of a bounce. And that's because you'd already moved so far up already. So you just have to think about how you're going to manage massive swing moves. Can you manage it in the first place is the biggest question. But once you rise and rise and rise, put your time frames up, drop your trade size. You cannot afford, if you want to be sustainable, you can't be trading large on every single one of these when the market's running away. Okay, and that's again why you need to follow market sentiment, because if you know the sentiment's still strong, you know there's a good chance that will keep going on, and it will make things much harder to trade. So put the time frames up, drop the trade size down, and use market inference from a long way back. Okay, because those are going to be your key levels for trading. So thanks for watching, guys. I hope that really helps. In the comments section is more on how to do that, the description. If it does or doesn't help, let me know, and I'll be doing more videos on risk management and capital management and all things like that. Because remember, to be a professional or profitable trader, someone who makes money long term, you have to be sustainable. Okay, sustainability is key. Thanks for watching, guys. See you in the next one.